So friends, now only everything got sorted out. Thank you for your patience. So some people are asking, unable to hear your voice. Yes, I didn't speak anything at all, but I asked you to try the problem, right? Friends, in this problem, the grant is on 1st April 2009, whereas the vesting period is 2.5 years. So where the vesting period is more than 1 year, the amount of expense to be borne by the company should be estimated at the end of every year, like what we did in the second problem. And we have to recognize it over a period of the vesting period. So if 1,000 stock options are available at the rate of 40, whereas the market price is 160, the company is ready to absorb 120 rupees per option in favor of the employees. So that is a total cost to be borne by the company over a period of 2.5 years. So therefore, at the end of every year during the vesting period, we will have to recognize the amount of expenses which should be or which is estimated to be borne by the company. How do we do that? See, for this only we are preparing this working note. Friends, what is the date of grant? 1/4/2099. The vesting period is 2.5 years. That means from April 9 to September 11. That is the vesting period. Vesting date is 30th September 2011. See whether you have done like this. Exercise period is 1 year from the vesting date. That is from 1st October 2011 to September 30, 2012. That is vesting period. So what is the last date to exercise the option? 30th September 2012. So the total employee compensation will be 1,20,000. How 1,20,000 options are there? Market price is 160, whereas the exercise price is 40. So the remaining 120 is the cost to be borne by the company over the period of 2.5 years. So the vesting period is 2.5 years. How much of the expense is to be amortized every year? 1,20,000 to be absorbed in 2.5 years. So for 1 year, by following straight line method, we have to absorb 48,000 rupees. See, if the grant, vesting, exercise, everything happens in 1 year, then accounting is very simple, just 4 entries. We'll complete it. But here, the vesting period is 2.5 years, then exercise period is 1 more year. So what we have to do in such cases, the total compensation expense is to be estimated and should be absorbed over the vesting period. Total expense is 1,20,000, vesting period is 2.5 years. So every year, the company should absorb 48,000 rupees. So at the end of the first year, that is 31/3/2010, we have to make entry for ESOP outstanding. Employee compensation expense account debit to ESOP outstanding 48,000 rupees for 1 year. So from April 9 to March 10, 1 year lapsed. For 1 year, the company should absorb 48,000 rupees. This being an expenditure amortized, we have to take it to the profit and loss account. So P&L account debit to employee compensation expenses transferred to P&L. So first thing is determining the expense to be recognized. Debit employee compensation expense to ESOP outstanding. Transfer that to the profit and loss account of the first year. Now one more year, another 6 months are there. So come to the end of the second year. Did anything happen in the year 2010-11? In between anything happened? Nothing happened. So therefore, the same two entries to be made at the end of the second year also. Employee compensation expense account debit to ESOP outstanding account. Similar to the last year, you have to transfer this expenditure to the profit and loss account. So if the vesting period is more than 1 year, this is how the amount of expense to be calculated, and this is how accounting should be done. But vesting period is up to 30th September 2011. But even before the vesting date, it is given in the problem that some unvested options, even before the option got vested, some unvested options lapsed. That means out of 1,000 options given to the employees, only 700 options are available on 1/5/2011. 300 options have lapsed. That means only 700 options are available. So if options lapse, immediately we will put an entry. Debit ESOP outstanding, credit general reserve. Because employee expense has already been taken to P&L. So the excess options, if any, recognized has to be reversed by debiting ESOP outstanding account and crediting to general reserve account. Now immediately what most of the friends will do is they will make entry for lapse of 300 options, which is not correct. Why it is not correct? Let us see. Please look at this working note. "300 options lapsed, but whether we should make entry for lapse of 300 options or not, we have to calculate correctly. What is granted 1,000 option, amount $1,20,000. What is already recognized out of 1,000 option? How many options are recognized already? First year 48,000, second year 48,000. That means 96,000 rupees is recognized, which is equivalent to how many options? 800 options. Because one option is 120 rupees. So to what extent expense has been amortized so far? 48 in the first year, 48 in the second year. That means out of 120,000, 96,000 is already recognized, which is equivalent to 200 options. Therefore, how many options available? Only 700 is available. Out of 1,000, 300 lapsed. Only 700 options are available, which is equivalent to 84,000 rupees. So from this, what do you find, friends? We have already recognized 800 option, 96,000 rupees. But what is available is only 700 option, 84,000 rupees. That means you have to make entry for reversal of 100 options only, not 100 option. Why? 1,000 options have not been recognized so far. In the first year, you recognize 400 options, 48,000 rupees. Second year, another 400. So at the end of the second year, the number of options recognized is only 800, amounting 96,000 rupees. But as on 1st May 2011, only 700 options are available. So excess option recognized, that only should be reversed, not 300 options. So the option reversal will be for 100 options amounting to 12,000 rupees. So this is very important working. Okay. In other words, we should make entry for reversal of 100 option to the extent of 12,000 rupees only, not for 300 options. Because unless you recognize, how can you reverse it? You recognize 800 so far, 700 is available. You have to reverse only 100, not 300. Clear? This is a very important working note. So in every problem where the vesting period is more than 1 year, then during the vesting period, at the end of every year, a certain amount of expense only should be absorbed. If any option lapses during the vesting period, then we have to reverse those options to the extent that is available only, not beyond that. So on 1st May 2011, we should make an entry for reversal of option ESOP outstanding account debit to general reserve account 12,000. This is a very critical adjustment. This is where students make mistake. So please note it carefully. Okay. So on 31/3/2012, we need not recognize some more expenses. Why? Out of 96,000 already recognized, 12,000 is reversed. Now the balance is 84,000 only. That is equivalent to 700 options. So on 31/3/12 or 30th September 11, we need not make any more entry for recognition of additional expenditure. So we come to the exercise period. What is exercise period? From September 2011 to October 2012, out of 700 options available, 600 were exercised, 100 lapsed. So now we have to make entry for exercise of 600 options. What is the entry for exercise? Bank account debit, ESOP outstanding account debit to share capital to security premium. So bank account debit will be how much? 600 into 40, 24,000. ESOP outstanding, 600 into 120, 72,000. Capital is always credited with face value 6,000. Excess of market price face value security premium, that will be taken to security premium account. So friends, tell me, out of 700 options available, only 600 were exercised, remaining 100 option lapsed. You have to make entry for lapse of these 100 options also. What is the entry for that? ESOP outstanding account debit to general reserve, 12,000 rupees. Very, very interesting and important problem, which may carry 8 marks in the examination. Had you worked out the problems in study material, you might see this problem. If not, at least you work out all the problems in study material, friends. Okay. So we have completed the solution for this problem. Pass journal entry for giving suitable narration. We have done it along with 2 working notes. But for more clarity, I am going to show you the ESOP outstanding account. Though it is not required in the examination, I just want to show you this so that you'll have a better idea. First year, credit ESOP outstanding 48,000 rupees. Number of option 400. How? Because one option 120 rupees, 400. So the closing balance for the year is 400 options and 48,000. That will be opening balance for the next year. Closing balance of first year, opening balance of second year. Again, in the second year end, another 400 option exercise, that is 48,000. So on 31/3/11, the closing balance is 96,000, which will be the opening balance for the next year. So 400 in the first year, 400 in the second year, total 800 options. Now, out of this 800 option, the problem says 300 options lapsed. But how many options are actually given? 1,000. So out of 1,000, 300 goes. So the closing balance will be 700 options only. If options are 700, amount will be 84,000. Therefore, out of 800, deduct 700 option, only balance 100 should be reversed. So this is the entry we make for reversal of 100 options on 1st May 2011. So now at the end of that year, the closing balance will be 84,000 equivalent to 700 options. Out of that, 600 options are exercised. So out of 84, 72 goes, balance lapsed, that should be taken to general reserve. So like this, we have to do the problem. And if required and is asked in the exam, we can prepare ESOP outstanding account also. Though it is not mandatory, I thought, okay, let us show it so that you guys will understand it better. Examination, no need to prepare this account. So I'm showing this just for your understanding, okay? So if you have any questions on this, please ask me. Now I will be taking up another problem very similar to this, but slightly more difficult than this problem. These are the problems you can expect in the examination. Similar problems you can expect in the examination. Okay. Yeah, friends, I've completed the solution. If there are any questions, there are any doubts, please clarify. You can also note down these 2 important working notes. Showing entire problem in one screen is not possible because it will not be visible. If I show the entire problem in one screen, it won't be visible. You won't be able to see anything at all. Anyway, I will try to show the entire problem in one screen. See whether you're able to see anything. This is how the entire problem can be shown in one screen. So this is an easy problem, friends. Carrying around 8 marks in the exam, we are supposed to finish it in 15 minutes or maximum 20 minutes. Provided you are very clear about ESOP accounting, you can easily do this problem. Problems like this generally appear in the examination. Okay, let's now move on to the next problem. Fourth problem. See, again, the fourth problem appears to be a very simple one, just 4 lines and 4 sentences only. Appear to be simple, but actually it is not. Why? The reason is very simple, friends. See, the vesting period is 4.5 years. After that, we have another 1 year for exercise. So therefore, we should do accounting for how many years? 5.5 years. Here also, vesting period is more than 1 year. So P Limited granted option for 8,000 shares of nominal value 10 on 1st October 2015 at 80 when the market price was 170. Vesting period is 4.5 years. So from 1st October 15, you add 4.5 years. That is the last date of vesting. Which will be what? It will be 31st March 2020, 4.5 years from October 15. So we have to do accounting up to that. The total expenses to be absorbed by the company should be accounted over the 4.5 years period. But in between, certain options have lapsed. That also we have to account. Then 6 months from the date, 3,000 options are exercised. 8,000 were given, 4,000 lapsed before it vested. After it vested, 3,000 were exercised, 1,000 lapsed at the end of exercise period. You have to make the journal entries for the above test. So similar to the earlier problem, but slightly bigger. More number of years, accounting should be done. How are we going to do this problem? See here. See, friends, as I do the problem, you do along with me. No point in just noting down or taking a screenshot. It may not help you. I'll tell you clearly. It doesn't help you by just taking a screenshot. I wanted to do it along with me, so it'll be very useful to you. So again, working note for amortization, we have to do first, right? Then we will do accounting. First, we should do the working note number 1 for amortization. What is the grant date? What is the grant date in this problem? 1st October 15. Vesting period 4.5 years. So when the vesting period will come to an end, 31/3/20, that is 4.5 years from 1/10/15. Exercise date from 1st April to September, 6 months. Number of options granted 8,000. Intrinsic value per option is how much? 170 minus 80, that is 90. Therefore, total expense to be recognized will be 7,20,000. That is 88,000 into 90. Assuming all the options may be exercised, the company has to recognize 7,20,000 rupees over a period of 4.5 years. Therefore, what is the expense to be amortized every year? It will be 1,60,000. That is 7,20,000 divided by 4.5. This working note is very, very important to determine the amount of expense to be absorbed every year. So in every problem, friends, this working note, you should keep it ready. Now we have to go to the end of the first year. What is the entry end of the first year? We have to recognize expenditure and the liability. Employee compensation expense account debit to ESOP outstanding account. We're amortizing the expense over a period of 4.5 years. What is the amount? 80,000. Don't put 1,60,000. Why? 1,60,000 is for 1 year. But now we are putting entry after 6 months from 1st October to March. So it will be 1,60,000 into 6 by 12. Half of that will be recognized in the year ending 31/3/16, transferred to P&L. Employee compensation expense account debit is of outstanding 80,000. Transfer to P&L. P&L account debit to employee compensation expenses. Now come to the next year. Next year also same entry because nothing happened in that year. 4,000 option lapsed on 1st December only, that is next year, 17/18, not in 16/17. So it will be same as the first year. But amount will be 1,60,000 because it is for 1 year. Now, on 1st December 2017, 4,000 unvested options lapsed. Out of 8,000 offered, 4,000 lapsed. That means how many options are available at the end of that year? Only 4,000 are available. If 4,000 options only are available, the expense for that should be absorbed in the next few years, right? So how to calculate that amount? For that, we have to prepare working note number 2. Lapse of 4,000 unvested options. Now what is granted? 8,000 option, amount 7,20,000. Available for exercise is only 4,000 because 4,000 lapsed. How much is already recognized? 240. How I got this number? 80 in the first year, 160 in the second year. Therefore, how much is the expense to be recognized in 2.5 years? That will be 2 lakh. How 2 lakh? 4,000 options are available, which is equal to 3,60,000 rupees. That should be absorbed in 4.5 years. So divide by 4.5, multiply by 2.5. Why 2.5? At the end of this year, 2.5 years over. So therefore, available is 360, already recognized is 2 lakh, to be recognized is 2 lakh 40, to be recognized is 2 lakh. So what is excess recognized? 40,000, only that is to be reversed. Are you able to understand, friends? Granted 8,000 equal to 7,20,000 rupees. But now only 4,000 option available. So you should have recognized 3,60,000 rupees in 4.5 years. But already we recognized 240. So in 2.5 years, how much you should have recognized? 360 divided by 4.5 2.5. Only 2 lakh should have been recognized for 4,000 options in 2.5 years. But already 240 is taken to P&L account. So excess of 40,000 should be reversed and transferred to general reserve. For more clarity, I am showing it here. See here, amount 360 to be absorbed in 4.5 years. But now 2.5 years gone. So the amount to be absorbed is 3,60,000 by 4.5 into 2.5, that is 2 lakh. So in 1 year, 80,000 should be recognized. So 80,000 1 year, another 80,000 2 year, half year 40. So you should have recognized only 2 lakh for the 4,000 option in 2.5 years. But already in the first and second year, 80,000 and 160 has been recognized to the extent of 2,40,000. So the difference of 40,000 should be reversed. See, this is one way of doing the problem and more appropriate way of doing. You can do the problem in the same manner I did in the first problem also. That is also acceptable. What I did in the earlier problem, out of 8,000 option, how much is recognized so far? How much is available? There is excess, we have to reverse it. The deficit, we have to account it. But what I have done is another technique, easy. Initially 8,000 options were given, but 4,000 option got cancelled. So from now onwards, we should account for 4,000 options only. 4,000 option is equal to 3,60,000 rupees. That should be absorbed in 4.5 years, but now it is 2.5 years only. So it should be 2 lakh. But already recognized is 240. Therefore, excess 40 should be reversed. So at the end of 2.5 years, you can see in the ESOP account, the balance will be 2 lakh only. See, this is what you should achieve. Okay. So therefore, what is the journal entry on 31st March 18? We have to make entry for reversal of 40,000 rupees. ESOP outstanding account debit to general reserve 40,000. So friends, at the end of every year, the balance in the ESOP account should be equal to the number of options multiplied by the intrinsic value. If 4,000 options are available to be exercised after 4.5 years, in 2.5 years, 2 by 5, sorry, 2.5 should be divided. Only that many number of options should be exercised in the ESOP outstanding account. But you find that more options are recognized, therefore excess is reversed. For better clarity, again, I'm going to show you the ESOP outstanding. Please see carefully, friends. Yeah, please see this. First year, you have recognized 8,889. Second, another 889, that is 80,000. So in 2 years, how much you recognize? 2,667 options already recognized. That is equal to 2,40,000. 889 in the first year, 1,778 in the second year. So on 31/3/17, 2,667 options already recorded to the extent of 2,40,000. But during the next year, 4,000 options got lapsed. So only remaining 4,000 should be amortized over the remaining period of 2 years. So if 4,000 options are available to be absorbed in 4.5 years, how many options will be there at the end of 2.5 years? It will be only 2,223 options. 4,000 by 4.5 into 2.5, that is equivalent to 2 lakh rupees. So you have already recognized 2,667. You should have recognized only 2,223. So the remaining 444 excess options are reversed and taken to general reserve. That's what we have done here. Now coming to the next year. Next year, very simple. Nothing happened in the next year, right? So what we should do? 80,000 rupees should be amortized now. 80,000 rupees for 1 year. The total amount is 3,60,000 for 4,000 option. If you divide by 4.5, you will get 80,000 rupees. So on 31/3/19 also amortize 1 year expenditure, that is 80,000 rupees. Again in the next year, nothing happened. So same entry. Same entry. Employee compensation expense account debit ESOP outstanding 80,000. P&L account debit ESOP outstanding 80,000. See, as long as there is no cancellation or lapse, you have to simply account 80,000 rupees every year. Now, if you post this in the ledger, it will appear like this. So, in the third year, another 80,000 equal to 888 option. Fourth year, 889 option, 80,000. So, at the end of 4.5 years, you see how many options are there? 3,60,000 options are there. See, this is what we should achieve, friends. At the end of the vesting period, you should have amortized expenses equivalent to the available options. That's what I did in the earlier problem also. That's what I do in this problem also. Is it not? See, in the earlier problem, how many options were available? 700. 84,000 I recognized. Here, 4,000 option, 360. This is what you should achieve. In study material, they would have done it differently also, no problem. See whether in the study material also, the final balance at the end of vesting period is 4,000 options and 3,60,000 rupees. A different method can be adopted, but the final answer at the end of the vesting period should be 3,60,000 rupees in ESOP outstanding account, which is equivalent to 4,000 option. Okay, it can be done in the manner given in the material also. It can be done in this manner also. Both are different approaches, but same answer. Okay. So now very simple. 3 months, 9 months, 6 months later, they've exercised only 3,000 options. Only 3,000 options are exercised. Entry for exercise of 3,000 options. Bank account debit is 3,000 into 80. ESOP outstanding is 3,000 into 90. Credit capital face value excess will be taken to securities premium. So out of 4,000 options available, only 3,000 option exercise, 1,000 options lapsed. So when options lapse, you have to make an entry like this. ESOP outstanding account debit to general reserve 90,000. Why general reserve is credited? We have recognized excess money in the P&L, assuming that all the 4,000 options may be exercised. But employees did not take up all the option. Out of 4,000, they exercised only 3,000. So the amount of 90,000 rupees equivalent to 1,000 options has to be cancelled and credited to general reserve. This is the type of problem with maximum difficulty that can appear in the examination. So continuing the ESOP outstanding account, it's like this. 4,000 options available at the beginning of the fifth year, amounting 3,60,000. 3,000 options were exercised, so balance 1,000 option unexercised transferred to general reserve. So at the end of the exercise period, ESOP outstanding account will be nullified because the time limit to exercise is lapsed. Hence, there should not be any balance in the ESOP outstanding account. So whether to open ESOP outstanding account? No, but I have done it so that you will understand. It's purely for understanding purposes. I am showing you the ESOP outstanding account, not for any other purpose. So this is ESOP outstanding account, and these are the working notes for this problem. May be helpful to you. Please see whether you have understood this. You could ask me, sir, can I do the same method for the last problem also? Yeah, you can do that, no problem. Or can I apply the first problem technique in this problem? Yeah, you can do, not a problem. But I just want to show you different ways of calculating. That's why I did one problem like that, one problem like this. It's after all estimation, right? Ultimately, in the options account, the final balance at the end of the vesting period should be 3,60,000. In between, okay, estimation made in a manner, estimation made in a different manner, the amount could be different during the vesting period. It's not a mistake. It depends upon how you perceive the solution. So these are the last two entries relating to exercise of 3,000 options and lapse of 1,000 options. So, okay, friends, I believe you're clear with ESOP accounting, employee stock option. And since it's rapid revision, we cannot stay on one particular chapter. I would like to go to the next chapter. Correct? What is that? Buyback. On buyback, I have given you another three problems. Fifth problem, sixth problem, seventh problem. In that, the fifth and seventh problem are actually easy. Sixth problem is the most difficult problem. Okay. Anyway, let us do all the problems in the class. Emerge Limited provides the following balance sheet. On 31st March 2012, rupees lakhs. Equity share, preference share, capital reserve, revenue reserve, premium, 10% debenture current liability, fixed assets less depreciation, investment at cost, current asset total, all in rupees lakhs. The company redeemed the preference shares at a premium of 10% on 1st April 12. It also bought back 3 lakh equity shares of 10 each at 30 per share. The payment for the above made out of huge bank balance replace part of the current asset. So you have to make entry for redemption of preference share and also buyback of equity shares. Included in its investment were investment in own debenture costing 2 lakh, face value 2.2, debentures cancelled on 1st April 2012. You have to make entry for cancellation of own debentures also. The company had 1 lakh stock option outstanding on the above mentioned date to employees at 20 when the market price is 30. This is included in current liability. On 1/4/12, employee exercise option for 50,000 shares. You have to make entry for exercise of 50,000 option, cancellation of own debenture, buyback of share, redemption of preference share. And then you have to prepare the balance sheet also. So even though redemption of preference share is in your group 1, they have asked that in this question in group 2 also. We expect that you would have completed group 1, then only you come to group 2. That is why redemption of preference share forms part of this question. Because very rarely somebody will first write group 2 and then group 1. So assuming that the students have appeared group 1 already, we are asking a question on redemption of preference shares also, even though it is not part of the syllabus. You can still argue, sir, preference share is not there in group 2. How can you ask me? I really do not know, friends, but this is how it came in the exam. And students were expected to do this in the exam. So better, let us attempt this problem. So we have to make journal entries in the books of Emerge Limited for redemption of preference share, for buyback of equity share, cancellation of own debenture, and exercise of stock options. After that, we are asked to prepare the balance sheet also. So let's start with the journal entries on 1st April 2012. First, we will account for redemption of preference share. So debit capital, debit premium, credit preference shareholders. This is the amount due to preference shareholders. Okay. For the purpose of redemption to preference shareholders, the company has utilized the reserves, or they can make a fresh issue where the reserves are not sufficient. But see, in this problem, we have a revenue reserve of 50, premium of 60. So we can easily make use of that for the purpose of redemption. For the premium on redemption of preference share, the balance in premium can be used unless it is a company governed by section 133 of the Companies Act. Normally, the premium on redemption of preference share is paid out of the P&L, but in this problem, we don't find P&L at all. We have revenue reserve, we have premium. So therefore, I'm using security premium for the purpose of payment of premium on redemption of preference shares. For the 20 lakh rupees of redemption, we can use the free reserves. So we'll make entry revenue reserve account debit to CRR 20. So the face value of preference shares redeemed is paid out of the free reserve. So you have to transfer from revenue reserve to CRR face value of preference shares redeemed, which is 20 lakhs. Then the entry for payment to preference shareholders. How much is paid? 22 lakhs. So these are the entries for redemption of preference share. Buyback of equity share also similar accounting treatment, is it not? For the premium, you can pay out of security premium. For the face value buyback, you can make use of the free reserves. And then finally, you have to make the payment to the shareholders. So here also 4 entries you have to make. All entries are made on 1st April 2012. So first entry is for amount due to equity shareholders on buyback. So how much is that? 30, premium 60, total 90. Because the problem says 3 lakh equity shares are bought back at 30 per share. 10 rupees is the face value, but they're paying 30. That means 20 per share is a premium. So 60 lakh will be premium on buyback, 30 is equity capital, total 90. Premium on buyback should be paid out of the security premium. For that, the entry is security premium account debit to premium on buyback, 60. Securities premium account debit to premium on buyback, 60. But for the face value of buyback, you are going to utilize the free reserves. So from free reserves, you have to transfer to capital redemption reserve, the extent of 30 lakhs. See, the entries are similar. First entry by due, here also due entry. Second entry, utilizing security premium for the purpose of premium on redemption or buyback. Third entry, face value of redemption or buyback is paid out of revenue reserve transferred to CRR. So what will be the fourth entry? Very simple. Payment to the shareholders. Equity share buyback account debit to bank account 90. Equity share buyback to bank account 90. So that's why I put it side by side for easy understanding. The entries are similar. Are you able to see that, friends? Entries are similar. So if you know redemption of preference share, you can easily do problems on buyback. Or if you know how to solve problems on buyback, you can easily do problems on redemption of preference share. The only difference is premium on buyback can be paid out of security premium, whereas premium on redemption of preference share cannot be paid out of security premium, which should be paid of P&L only. But in this problem, there is no P&L. Therefore, I'm utilizing the balance in security premium. Okay. So, friends, are you clear or you have any questions? So, adjustment number 1, redemption done. Number 2, buyback done. So, what is the third adjustment? Cancellation of own debentures. In fact, cancellation of own debenture is also in group 1. But still, they are asking you to do this. So, we have to make entry for that. Cancellation of own debenture. What is the entry? Debit debenture account face value, that is 2.2. Credit own debenture cost, that is 2. Excess will be taken to capital reserve. Gain on cancellation of own debenture should be taken to capital reserve. So if 2.2 lakh is the face value of debenture, cost of own debenture is 2 lakh, the gain is 20,000, that is taken to capital reserve. Now we have to make the last entry, exercise of 50,000 option. Very easy, right? Bank account debit. How much? 50,000 into 20. ESOP outstanding account 50,000 into 10, because 10 rupees is the exercise price, whereas the ESOP outstanding account is at the rate of 30. So debit bank account 10 lakh, 50,000 into 20, ESOP outstanding 50,000 into 5, 10. Equity capital is always credited with face value. Excess goes to premium, 10 lakh. So that is a journal entry for the exercise of 50,000 options. You see, the market price is 30, issue price is 20, intrinsic value 10. So that is what is debited to ESOP outstanding account. So we have made all the journal entries, correct? Journal entry for buyback, journal entry for redemption of preference share, journal entry for cancellation of own debenture, journal entry for exercise of ESOP. So all the entries I am showing on one screen. You can note down if you want. So understood? Then straight away, we can now go and prepare the balance sheet. After all these adjustments, how the balance sheet will appear. So friends, do you have any questions up to this point? Okay, there are no questions. Let's move on. So, I have a question from Kaushik. He's asking, can we directly transfer from security premium instead of transferring to premium redemption, etc.? Yes, you can do it, but it is advisable to do like this. First, record the premium, then utilize the security premium. That would be better. That will be more meticulous. I prefer doing it like this only. But even if you debit premium directly here, it is not wrong. You can do like that also. Because first you are debiting premium, you are transferring to security premium. Ultimate effect is what? Premium gets nullified. You are debiting security premium. Not wrong. But better do like this, friends. It will be more appropriate. It will be more meticulous. Okay, Kaushik. You can follow this method. Now, friends, we have to prepare the balance sheet. Balance sheet, as you know, should be prepared in the Schedule 3 Companies Act format, correct? That means we have to show share capital, reserve surplus, share application, money, pending allotment, then non-current liability, current liability, assets, non-current asset, and so on, correct? Like this, you have to record. So first share capital. What will be the share capital, friends? It will be 7,50,000 shares of 10 each. $75 lakhs. Of the above, 50,000 shares are issued against ESOP. How I got 7,50,000 shares of 10 each? See, earlier it was 100 lakhs capital, 30 is bought back minus 5 is issued for options. So therefore 75 lakhs, which is equal to 7,50,000 shares of 10 each. So therefore share capital will be 75. Then reserves and surplus. Capital reserve already given in the question is 8. Profit on cancellation of debenture is 20,000. So we have to add it. So now the closing balance will be 8.2. Next. Security premium opening balance was 60. ESOP issue resulted in 5 lakh, 10 lakh premium. Utilized for buyback is 60. And redemption. Total how much utilized? 62. 60 for buyback. Redemption 2. Total 62. Therefore, the closing balance will be 8. And on redemption and buyback, you transferred a certain amount to CRR. What is the balance? 50. 20 lakhs for preference share, 30 lakhs for buyback, transferred from general reserve to CRR. So CRR balance will be 50. Therefore, what is the total of reserves and surplus? That will be 66.2. Put it here. So share capital $75, R&S 66.2, share application money pending allotment is 0, non-current liability, yes, we have. Because debentures issued 4 lakh, out of that you have cancelled own debenture, so you have to reduce it. So 10% debenture, how much? For cancelled 2.2, balance 1.8, that will appear in the balance sheet. Out of 4 lakh worth of debentures issued, 2.2 own debenture cancelled. So debenture value will reduce by 2.2, so the balance is 1.8. Current liability also, we need to prepare a working note. Current liability as given in the question is 70. But we have issued shares upon exercise of option. The ESOP outstanding is included in current liability. So when the options are exercised, to that extent, current liability will reduce by 5. So the balance is 65. See, we have debited ESOP outstanding, no? 5 lakhs. When you debit, automatically it will reduce. So ESOP issue will reduce the current liability, balance is 65. Fixed asset, there is no change as given in the question. 50 remains as it is. Investment, 120 minus 2. When you cancel own debenture, the cost of such debenture is 2. So 120 minus 2 is 118. Current asset, working note number 3. Current asset, what is the opening balance? 142. ESOP issue, receipt of money 10. Preference share minus 22. Buyback minus 90. So the final balance in current asset is 40. Current asset final balance is 40 lakhs. So therefore, what is the closing balance sheet total? Total of balance sheet is 208. That is the balance sheet total. So balance sheet on one side and notes on the other side. Like this, you have to present the answer in the exam. If you present it like this and your answer is also right, full marks will be given. For example, for this problem, if 10 marks are allocated, full 10 marks will be given. But friends, in this problem, I made an observation. Did you make an observation? This is an important observation. As per section 68 subsection 2 of Companies Act, buyback cannot exceed 25% of its paid up capital. See, the paid up capital is 100, but the buyback is 30. It cannot be more than 25% according to section 68 subsection 2 of Companies Act. Practically, it is not possible. According to Companies Act, buyback cannot be more than 25% of paid up capital. But in this problem, they are given 30%. Out of 10 lakh share, 3 lakh shares are bought back. Not allowed, not possible. But since it is given in the question, we have done it. So don't say the problem is wrong. Do the problem and you can make an observation like this. Don't say problem is wrong. Just say I've observed like this. That is more than sufficient. But if you do not want to take a risk, don't write the observation also, no problem. Nobody will bother that you didn't make that observation. But if you make an observation, the examiner, the paper valuer may be happy. Okay, this student is also able to see whether the problem is as per the Companies Act. That means you're telling the paper valuer, I know Companies Act also. So practically, buyback of 3 lakh share is not possible. Only 2.5 lakh shares could be bought back. That is why we had problem in the premium and all. Are you able to understand, friends? I'm very surprised nobody asked me the question. Sir, premium only 60 is, how can you use 62? Nobody asked that question. See the balance sheet given in the question. Premium is 60 only, but I use 62. How? 2 for preference share, 60 for buyback. How can I use 62 when only 60 is available? Nobody asked that question. Probably you are also aware from ESOP issue 10 lakhs of premium will arise. I have not done it wrongly. I knew that from ESOP 10 lakh premium will arise. So I'm using that. So these are the difficulties in this problem. So therefore, the actual buyback should be maximum 2.5 lakhs only. In that case, you won't have the difficulty in adjusting the security premium. And another thing in this problem, for premium on redemption of preference shares, security premium should not be used as per section 133 of the Companies Act. There is no balance in P&L. Therefore, we utilize security premium, assuming this company need not comply with section 133 of the Companies Act. Similarly, the profit on cancellation of own debenture is a profit of capital nature. It can't be taken to P&L. It has to be taken to capital reserve only. So therefore, profit on cancellation of own debenture will go to capital reserve. It is a profit of capital nature. That is why it is taken to capital reserve. Hope you understood the solution, friends. Like this, we have 2 more problems on buyback. But in that, I will first do the next problem because that is more difficult. Very likely, such problems may appear in the exam. If time permits, I will do the next problem, last problem. That is actually simple problem. Anybody can do it. But the next problem is a real tough problem. So let us take a break now. After the break, I will do problem number 6 first. Then I will try the next problem. So friends, it's time to take a break. Please join after the break, okay? Of course, if you have any question, put it in the chat. I will try to answer.